Hello, everyone, and welcome back to Your Finance TV. After a week's break, we've got Jay Pelosky back. How are you, Jay?
Good, Scott. I missed you last week.
I missed you as well, buddy. So a little bit on my plate, but we're back, and we're here to talk about your amazing musings after a lot of media appearances this week. Now, I love the title of your musings this week because I've been talking about this the last 3 weeks with clients and so forth. Buy the Laggards. Now, I don't think that's really any explanations needed about that, but why did you come up with that title?
Well, yeah, it's not like some of my others, right, where we go back and forth on a movie analogy or a music analogy. This one is pretty basic, and I think it's time to be basic, right? I mean, we've had a lot going on in the markets over the last couple months. We wrote about Trickster, about the trickiness of this market. We advised clients over the last month or so to stick to the process. That was another musings title. 2 weeks ago, I think it was zoom in, not out, or sorry, zoom out, not in, actually. Zoom out, not in. So we want to be thinking big picture. And then last week, which we missed at Your Finance TV, but we did publish our monthly, which was titled Rotation, Not Recession. And I think a lot of that has now culminated in a perspective that we at least see the ability to look longer term. And so we think we're at the early stages of what's going to be a long cycle, what's going to be kind of an elongated cycle. We heard the Chair Powell talk about recalibration and more, which I'm sure we'll get into. But all of the above leads us to think about a long cycle for risk assets, one underpinned by global central bank easing, abundant global liquidity, no major imbalances in the global or U.S. economy, flush consumers, cashed up corporates. All that tells us long cycle, and therefore we feel comfortable saying, let's buy the laggards.
Okay, just before we move on to mentioned Powell there, I want to bring up a headline that's come up in the market this morning that Jamie Dimon's skeptical of a soft landing. Now, obviously, Jamie's been right on point with everything he's come out with comments over the years. But what do you think about that headline?
I think he has not got a very good track record as a forward-looking prognosticator. Obviously, he's a great bank executive and has done really well at JP Morgan and other spots before that. But I don't really think that his kind of directional sense is very good. I think the last thing he said was, we should prepare for like a hurricane or something much worse than just a garden variety recession. And yet, if you look at the banks and if you look at JP Morgan itself, the research, the institutional research, which we have access to, it's quite constructive. And I believe they were calling for a 50 basis point cut, one of the very few banks that were doing so. And they highlighted just recently, and we noted in the musings today, that whenever the Fed has cut within 1%, when the S&P is within 1% of an all-time high, started a cutting cycle. They've done that a dozen times over history. And each and every time, a year later, the S&P was up on average of 15%. And so I think, and that brings to mind another point that we want to make, and we've stressed, is that it's really not the scale of the rate cuts or the pace of the rate cuts. Again, we want to zoom out, not in. We want to focus on long cycle. And so what's really important in our view, and history supports this again, is whether or not the Fed is cutting into a recession or not. History is very clear. If the Fed cuts into a recession, stocks go down typically mid-teens over the next 12 months, 15, 17% average decline. If the Fed cuts and there is no recession, stocks go up 15 to 20% over the next 12 months. So that's really the important point, not 25 versus 50. We run Bloomberg surveillance this morning. And of course, all the talk is about too much, too little, signaling with a 50 basis points versus a 25. And, to us, that's just kind of idle chatter. The real focus is recession or not. We wrote in our monthly, again, trying to be very clear. We pride ourselves at TBW Advisory of having a view, being able to articulate and support that view. And so the title of last week's monthly, Rotation, Not Recession.
And for anyone who's looking to get access to those, go to pelosky.com and you can sign up for those notifications. Now, let's get back onto Powell. Now, obviously, everyone's seen the 50 basis point cut. We've talked about it a lot now. Let's go into what the takeaways you have from his commentary afterwards.
Well, I think really the important one is the recalibration, the idea that we're shifting from a focus on defeating inflation. And remember, our very first global macro surprise for 2024 that we wrote about back almost a year ago now was lower than expected inflation sooner than expected. And so the Fed has now joined many other central banks around the world in shifting away from rate hikes to rate cuts. And Powell was also very clear to articulate that this is going to be a long cycle. He talked about this rate cutting cycle extending into 2026. He also talked about the R star or the neutral rate, where they think the rate of interest is that doesn't really affect the economy either way, up or down in a meaningful fashion, to be somewhere around 3%. That's very different versus what folks thought R star or the neutral rate was post-Great Financial Crisis, when most people felt it was around zero. That to us suggests that the global economy is actually healed from the Great Financial Crisis. And it kind of supports our thinking that there are two signs of significant underlying strength that support our view that we're at the early stages of a long cycle. The first in the global economy is that the economy was able to deal with and absorb a very aggressive rate hiking cycle from 2022 through 2024 without a recession. That suggests the global and U.S. economy are quite strong underneath everything. The second signal of strength was how the S&P and ACWI, all country world, so global equities, have been able to make new all-time highs, even though the leadership sector, tech, and the bellwether tech stock, NVIDIA, are still down meaningfully. NVIDIA is still down about 20% from the high it made earlier this year. So that suggests rotation. And that suggests, as we said in our monthly, that that's how we want to be thinking about things. The market is demonstrating underlying signs of strength. Chair Powell kind of reinforced that. We see that as suggesting a soft landing. A soft landing, remember, global macro surprise number 3, return to stability. We think we are there, getting there. Early cycle, not late, was the macro surprise number 4. We're starting to identify that. And all that tells us that our longer term thesis, what we call the global macro blue sky thesis of 2023 through 2027, now syncs up with the Fed looking for rate cuts through 2026. So we think things are aligning to, again, suggest investors should be focusing longer term, should be zooming out, not in, and should not be worried about buying laggards here, because this cycle is going to extend and those laggards are going to become leaders.
Okay, well, let's take all that and put it all together. You've had your monthly model portfolio meeting. What have you guys got your takeaways from all that side of it?
Yeah, I mean, it's great when you put all that together, right? So this week was busy, as you suggested. We had Bloomberg this morning. Earlier in the week, we did an hour-long podcast with the folks at Macro Hive. That's always great, a chance to really dig in and really unspool your thinking. And then this week was also where we had our monthly model portfolio update meeting. And so we went through all the charts. We went really deep into our portfolio. And so this week, we're able to really bring all those things together to clients and to folks like your viewers. So the takeaway for us is, as we said, is simple. We want to buy the laggards, right? We don't think there's going to be a recession. There's no sign of a recession. The Atlanta Fed is suggesting Q3 GDP is going to be 3%. Global growth has averaged 0.5, 0.6% for the last 2 years, another sign of stability. And yet within the markets, there has been a kind of dichotomy of pricing. And we touched on this in our monthly at some degree, namely how bonds and bond sensitive parts of the equity market like utilities, together with commodities, have priced in a recession. And while at the same time, stocks and credit did not. And we thought and argued that credit was the tell. In other words, credit not breaking down suggests the fears of recession are overblown. So today, going forward, what we want to do is we want to sell those segments of the cross-asset markets that have benefited from the recession call. So we don't want to be jumping into utilities here. We don't want to be buying the 10-year Treasury at 3.7%. But we do want to take advantage of the things that have been hit due to recession fears, thus commodities. And so we really think the commodity segment of the marketplace is really appealing, really attractive right now. And so when we think about, and again, not JP Morgan this time, but Bank of America came out this week and noted that institutional allocation to commodities are at a 7-year low, right? Hedge funds are as short as they've been in commodities for at least a decade or more. You know, you look at oil, we quote an oil expert at 3F, the energy firm, talking about they've never seen such, they're at maximum speculative negative positioning. So we think a lot of things are lining up. If we're early cycle, if we're not going to have a recession, if we have this real imbalance between how people are positioned in the commodity space, at a time, by the way, where inventories are very low, whether it's oil, Cushing tanks almost empty, whether it's copper, whether it's uranium, inventories are very low. So first off, we want to be buying commodities. We also want to look at other laggards like small caps. History, again, very clear. Small caps lead, they outperform in the first 6 months after the first rate cut. So we like small caps. We like the thematic space. We're looking at things that have been basing for several years. Remember, we have two models, one our global multi-asset, really our flagship, and the other being our TPW20, which is thematic. So we pay close attention to the thematic space in future tech and climate. And we're seeing a number of those segments, fintech, biotech, robotics, starting to really move. And then to complete the circle, we want to keep hold of our winners and our leaders, right? And leaders have been things like financials, things like industrials. We think one of the surprises over the next couple of months is going to be the ISM manufacturing PMI coming out above 50. We think that's going to really shock a lot of people. And so but you look at industrials, and industrials are leading. So stick with financials, industrials. We continue to like semis. In the other space that we should really mention, of course, is China. We were asked again about our China thesis on Bloomberg this morning. And, you know, we continue to hold to the view that in a two tech stack world where China and the US are walling off their tech spaces from each other, China tech is very, very compelling, very cheap relative to history, cheap relative to the US peers, buying back stock hand over fist. And by the way, starting to really make inroads in things like AI. And we noted in the musings that Alibaba just announced that its new large language model has record-breaking performance and is now the best performing open source large language model in the world. So China tech is a real thing and very compellingly priced and very, very under-owned. And so that's another example of a laggard, because when we look at who's been leading, it's been the US. So another laggard is the non-US space. And amidst all this, we think the dollar is going to weaken as the Fed cuts and as the rest of the world recovers. That should be good for non-US equities. That should be good for commodities.
Well, thank you very much, Jay. What do you want for the weekend? Is Duke going to continue their unbeaten streak?
Yeah, well, it's kind of the easier segment of the schedule so far, right? We've played all non-conference opponents. And yes, this Saturday could be another victory. But hey, it's always nice to be undefeated 3 weeks into the season, and we hope to be undefeated after week 4. And then I think it gets a little bit more interesting. I think our arch rival, North Carolina, is coming up very soon, and that's a game that we'll have a little bit more attention paid to. But yeah, little football this weekend, and other than that, it's been a busy week. So I think just some R&R time. How about yourself?
I think I'm always just looking for R&R time, Joe.
Good answer. All
All
right,
right.
buddy. You enjoy that R&R time. You deserve it.
I will, and we'll speak to you again next week, okay?
Sounds great.
And for everyone else out there, good luck investing.